Have you ever wondered why some goods are pricier than others? Or why certain services are scarce? These questions lead us towards a fundamental concept in economics, an intricate dance called supply and demand. Let's break it down. Supply, in simple terms, refers to the quantity of a product or service available in the market. It's what manufacturers, service providers, and sellers bring to the table. On the other side of this dance floor, we have demand. This represents our desires, our needs, the quantity of a product or service we, as consumers, are willing to purchase. The relationship between supply and demand is a delicate balance, a silent negotiation that determines the equilibrium price. This is the price point where the quantity supplied matches the quantity demanded. A beautiful equilibrium, a perfect balance. But it's more than just a balance. It's a dance driven by availability and desire. It's a delicate balance, a dance if you will, the dance of supply and demand. So, what are the strings that guide this dance, you may ask? Well, it's a multitude of factors, really. Let's start with supply. Production costs, technological advancements, and even external events like natural disasters can greatly influence the amount of a product or service available in the market. Take, for instance, the tech industry. A breakthrough in technology can increase supply by making production more efficient. On the flip side, demand is driven by consumer preferences, income levels, and external influences like trends or societal shifts. Consider the housing market. If a neighborhood suddenly becomes trendy, demand for homes in that area might skyrocket, pushing prices up with it. But it's not just about what's happening now. Anticipated changes in these factors can also significantly impact supply and demand. Businesses, consumers, and investors are always trying to stay one step ahead, predicting where the market will go next. But the influence of supply and demand extends beyond just dictating prices. You see, the ripples of this dance reach far and wide. Beyond the realms of price determination, supply and demand act as pivotal forces shaping the economy in more ways than one might imagine. Imagine a company contemplating the production of a new product. They don't just dive in, they gauge the waters, studying the market, anticipating demand. If they predict a high demand, they'll produce more. If not, they'll produce less. Thus, production decisions are deeply intertwined with supply and demand. But it doesn't stop there. Societies allocate resources based on where demand is highest. If people crave more digital technology, resources shift there, leading to growth in that sector. And what about innovation? Well, that's where things get interesting. High demand in specific sectors can spur innovation and technological advancements. Think about the smartphone boom, electric vehicles, or renewable energy technologies. However, it's not all smooth sailing in the world of supply and demand. The dance of supply and demand is often thrown off balance by unforeseen elements. Indeed, while the theory of supply and demand provides a neat framework, the reality is a bit more complex. Predicting supply and demand is like gazing into a crystal ball filled with fog. Numerous external factors, from sudden shifts in consumer preferences to unexpected natural disasters, can send ripples through our carefully balanced markets. Moreover, real-world scenarios introduce their own set of challenges. Government interventions such as subsidies or tariffs can distort the natural balance, while monopolies or oligopolies might manipulate supply or demand to their advantage. Yet amidst these complexities lies an art, the art of navigating supply and demand. By understanding the forces at play, we can better anticipate market trends, make informed decisions, and even influence the dance itself. Understanding the nuances of supply and demand enables us to navigate the world of economics with a bit more finesse and confidence.